It is December, ladies and gentlemen. Welcome to this edition of The Closing Bell. I'm Jason Jacoby, along with, of course, the better-looking co-host, Mark Boyer. Mark, how are you?
I'm doing great. Thanks, Jason. Your hair's looking good, nice and peppery, nice salty, salt and pepper, right? It's fun. And we're into
Bringing the
December.
flavor.
I'm thinking about food all the time because it's we just had Thanksgiving. Now you got Christmas coming. It's an awesome time of the year. It's colder.
Absolutely. I know. It's my favorite month of the year. Love Christmas, especially with kids. It brings out the inner kid within me. I don't know about you, but definitely
Love it.
looking forward to it. So, with salt and pepper, we look to bring some spice and some savoriness, if that's even a word, to your financial lives. Super fun to do this. We got a good one for you this week. We'll talk markets. We'll talk the latest inflation report, and finishing up and wrapping up Q3 earnings season, which should pretty much be done now. So why don't we get into it? First thing we want to talk about today is the personal consumption expenditure report, which came out this week. We'll kind of work our way through to what that means to the Fed, what that means into the markets. And that's kind of the flow and the journey that we'll take today. But the latest PCE numbers on a year over year basis, some good news. So we've been talking about cooling inflation. Headline PCE, which includes volatile food and energy prices, came in at 3%, down from 3.4% the previous month. And core year over year PCE came in at 3.5%, which was down 20 basis points from September. So, Mark, we're seeing cooling inflation, which is what we wanted to see. Obviously, inflation kind of reared its head, not much, but in the summer months, obviously with travel and consumer spending, funflation, we called it, spending on services, while goods lagged in contractionary territory. So, what are your thoughts here moving into quarter four here, and we're on December's doorstep. We're actually in the entryway now. Today's December 1st. What's going on with that?
Yeah, well, I mean, I think the numbers are coming in. The market is seeing a soft landing in the horizon. That's what's happening. We show in here then our chart. Let's jump to the chart here. You can actually see in the S&P 500, ever since numbers started coming in, that inflation was waning. We've had a real run in the market. We talked about this a couple months ago that the fourth quarter this time of year was usually you get a Santa Claus rally.
Mm-hmm.
October is normally the bear killer. A lot of people are concerned in October because we've had some big drops in the market in October. This one was no exception. You can actually see here, that in October the market actually had a third wave down. This was a high back in in the summer, July of this year, and then we had a wave down. One wave down, a second one, and then a third one that hit a low. And so when these inflation numbers started waning and it sounded like the Fed was beginning to say, hey, we may be less aggressive and so forth, we see that we hit that low, in late October, and that was the bear
Yeah.
killer. And now we've had a big run up. So the markets are anticipating, a pause in interest rates, which we've had. And
Mm-hmm.
even now it looks like we might be, there's even talk of cuts as early as May. So we'll see, we'll see what's happening, but the market's definitely anticipating that and pricing those numbers in now. So that's good.
Yeah, Jay Powell came out today and was talking about just exactly what you said. They said that they are cautiously optimistic that they're going to continue to pause. They think that the inflation will continue to recede a little bit more, and then they'll be very patient in lowering rates. So, markets pricing in, like you said, mid next year, mid 2024 for a first maybe 25 basis point rate cut. And again, this is early projections here. We're not witches or wizard with a crystal ball here. We're just talking what the market's pricing in right now, coming off those late October lows that you showed, right, Mark? Right there.
Yeah. So yeah, we've had this low here. You see it in the charts where, back in October, we had that low, kind of had a flush out. You can see in those times we had some decent volume on the bottom here. You can see the volume. And as we get that, the markets have been been rallying back up. I think a lot of it has to do with, if you show a chart here, the interest rates have been kind of the key. This is a chart of the 10-year yield, and you see that this is going back to last October a year ago. Rates came were down, and then we really started as inflation started hitting, and the bond market really started to rates started going up, and this was the kind of the hit to the bond market this last year, and here in October, that same period of time, the 10-year actually hit a high of almost 5%. I mean, everybody's talking about
Yep.
the 10-year having 5%.
Yep.
It did hit that, and actually spent a couple of days there, a few days up, and then slowly again, as we've seen here, the market started to really sell. The interest rates started to come down, and it's no coincidence at the same time as interest rates were coming down that stocks began to really accelerate again. So so I mean, I think that's a big key is the interest rates are in view. The concern when you have higher interest rates, it's cost more for everything, mortgages, everything costs more in borrowing, and when interest rates are high like that, and as they start coming down, the thought is, that loosens up the market a little, people's ability to borrow and in the economy a little bit. But that's all kind of what the Fed was hoping that would happen. Time will tell whether they've accomplished it, but right now the bond market's acting pretty well and favorable for both, for stocks for sure. And also, what's nice about this, if you've been in bonds, interest rates come down, the inverted relationship between bonds and interest rates, as interest rates come down, the value of bonds goes up. So if you're holding on to some, longer duration bonds, you're actually getting, again, some appreciation in those as well. So you're getting the higher interest rate and the appreciation. That's a huge deal, and why finally
total return.
Total return on the fixed income side. So yeah, it's good. It's a positive thing. We'll see. Right now that's what's happening in the markets, and we'll see what happens next year. We could see pauses soon, or frankly, I mean, I kind of lean towards, that might happen, but at the same time, I think we may stay here for longer, and whether we get cuts or not, I don't know, but we're definitely gonna, I think, the other chance is we stay higher for longer into 2024 before we get cuts into next year. So anyway, we'll see what happens. Time will tell.
Interesting points, and also, playing off of consumer sentiment, investor sentiment in general, thinking about, soft landing, or are we going to have a recession? Again, we're not in the business of telling the future. We can look at data, we can look at numbers, and make an educated guess. And so, all the people, all the big fund managers, and analysts that we work with and talk with, still think that a mild recession is on the cards. And again, that shouldn't scare anybody in terms of, we always go back to the worst memories, right? Those are always the ones that are imprinted on our brains. 2008, the Great Recession, and then even COVID. I mean, that was, again, unprecedented times with lockdowns, and the market quickly fell to 35% down within what seemed like an instant, right? So I think what consumers and investors need to remember, and citizens of our great country, is that, hey, economic slowdowns are okay, and they're part of the market cycle. We've had extreme inflation. The Fed has raised rates at a historic pace, and like you just said, rates higher for longer will probably be in effect. I was just reading an article this morning that one of our top managers that we work with, they think rates will settle between 3 to 6%. So on the mortgage side, I believe they're talking about. So again, if we can get back to some equilibrium and realize that this slowdown, it could end in a soft landing, which is fantastic because we've had a resilient economy. The consumer's been strong, labor market's still strong, though continuing claims this week did come in above 2 million continuing jobless claims. So we're actually right there at like 1.978 or 1.98. So we're sitting right there at that psychological level of about 2 million. which again is showing signs of a slowing economy. But it's been resilient. We've talked about this, Mark, and I think that as we move forward, worrying about recession or soft landing is really doing it an injustice. That we need to just focus on, again, our long-term goals, look for opportunity in the markets, positioning. You talked about the bond market. There was a method to our madness. People are like, why, and long-term investors we're asking, why are we holding long-term bonds right now? This is why we position in a barbell, philosophy, I guess you could say right now, taking advantage of short term, but extending duration and increasing quality in our bonds and our bond portfolios because of the fact that total return that you just talked about. So sorry for my rant, but I thought that was very important to put it in perspective that, things might be slowing down, but the markets react positively because there's a light at the end of the tunnel, whether it's a mild recession or a soft landing.
Yeah, you're exactly right. I mean, all those things are true. We don't know what what tomorrow holds, and we just don't. Everybody's making their best guess, but the key is, I think, because we don't know, is to we've said this many times: stay diversified. Have your money in different places, and look for those opportunities as the market changes. To make specific moves, perhaps in a more active portfolio. But I wanted to show a couple of things. One is this is the bond market. I just used the Vanguard Total Bond Mark. You can see here again. I showed that last. Interesting as the bonds come down. This is the point in regards to interest rates coming down. We see that bonds. This is sort of a basket of bonds, just one that you can look at. There's so many ETFs you can look at, but you can see that it bottomed out here in the 68 range. Again, back to coincidentally late October. And then November started, and you can see that the bond market or the price of bonds really has begun to move up. In fact, in this case, right to its 200-day moving average. So there's lots of charts that show that. Actually, that the bond markets are actually kind of at a pivotal point. They've moved back up to the 200-day. If it breaks that to the upside, that's positive. We can see lower rates from there. So it's interesting. Again, back to the longer term. That's why you want to have that barbell kind of duration in your bond portfolio, because you're getting that appreciation. The other place that's interesting is I just want to look at it. I had it up earlier, but let me go back to that. Is the dollar. This is another area that, as interest rates were high, the dollar was strong. Yep. But now you can see since October, again, same thing. The dollar's actually dropped in here. It's not down to its lows that were back earlier this year, but this helps. This helps the multinational. As the dollar drops, okay, that helps anybody who does business in other currencies. So your multinational companies. Different, anybody, if you buy international stocks, it's all beneficial to us in those investments too, as the dollar drops in here too. So anyway, you've had that combination of interest rates coming down, the value of the dollar coming down, that gives us, that it just sort of opens up opportunities for other places. And so again, diversification key. And we were talking about international stocks in here and making sure, as it, in those times where it's extreme to either side, you want to start adding into those areas. And so I think that's, again, back to the point is that you don't never know, but you never know everything, but, there's opportunities that you find that, you got to take advantage of.
Absolutely. So let's talk, wrapping up Q3 earnings for the S&P 500. We're pretty much done here. So I want to give some updated, preliminary numbers before audits. So, if you're looking at the S&P 500 as a whole, it's actually done pretty well in terms of earnings per share. It's on track for a 6% year-over-year increase, which is relatively pretty darn good.
Yeah.
But that actually exceeds 10% when you exclude the energy sector, which has kind of been a laggard the last quarter. Obviously, with the Russia-Ukraine war and geopolitical tensions, kind of not subsiding, but is kind of started to take a little bit of a back seat. That was kind of the big thing. And economies have started to adjust. It's actually hurt their bottom lines a little bit in the energy sector. We've started to see price per barrel start coming down as well right now. Again, with escalating Israel-Hamas war, and will Iran join in, and OPEC's meeting, they just postponed it. They're talking about further cuts to output, which obviously will jack up prices a little bit more, and obviously, higher cost per barrel could pad the bottom lines in future quarters for energy. So still a good sector to be in, but quite interesting. But just to wrap up quarter three before we kind of specifically get to your chart here, Mark, about the U.S. oil fund.
Yeah, this shows what you're talking about, is that
Yeah,
oil's come down in here. And so that's, it's holding around that 70, bucks a barrel trying to, but we'll see if that holds. But that's showing what's happened here in the recent months too.
good point. That's great.
Yeah.
And for our listeners, we do have a chart up here that, we do have a visual version here that you can find on YouTube. Just, type in Boyer Financial Services. Our videos will pop up. We do a lot of great different content. We have a different Move the Chains podcast, which if you haven't listened to, I encourage you to. Think about that as more thematic, kind of more inspirational. We sit down with top leaders, investment professionals, and entrepreneurs, just talking about their stories, and basically, they're professionals in their specific areas. So it's always good to hear different insight from different people. So go ahead and subscribe to that page. You can watch us, as good looking individuals as we are, but just more specifically for the educational content.
Mm.
But
Do
anyway,
better on radio.
Yeah, we're better on radio.
I'm better on radio.
Sound better on radio. But again, so if you look at the top performing sectors in terms of earnings, consumer discretionary, again, services, funflation. I love that word. I just keep saying funflation.
Funflation?
Funflation.
Funflation, like it. All right. So give me an example. What's funflation? Why is it fun, and why is it funflation?
For example, since you're such a big Taylor Swift fan,
Oh yeah, I loved
tickets for like $1,000, I think, and people would just clamor for them. So that just means like people that are spending money on experiences post COVID are willing to pay a really pretty penny for it. So it's like funflation. Gotcha. So it jacks up prices. But financials and technology also drove an average quarter three earnings surprise of 7.7%. So again, earnings have been resilient. If you strip out, the S&P 500 of those specific sectors, you actually get a little bit of like kind of a contractionary earnings per share, about like 2% or so. But it's really interesting to look at just the overarching theme of the S&P 500. So let's dive into markets. We've got some really good info for you here as we kind of move on. Obviously, the Magnificent Seven. Mark, I want to talk about that. Before we do so, give a quick brief rundown on the markets, how they've done this week. 1 week, Dow Jones, best performer. It's been a while since we've said that. Of the three major indexes, of course, actually. 2.42% for the week. S&P was up about 75 basis points. NASDAQ up about 38 basis points. Russell 2000 was actually the best performer. So small caps have started to rally again. It's good to see, though they are still down based off of the past 12 months in arrears, still down over 1.5%, but up, and the leader for the week at almost 3%. So Magnificent Seven, crazy returns, have basically doubled in value this year, outperforming the S&P, which is up 19.6% for the year. So let's talk a little bit about that. Let's talk about S&P 500. If you could pull that chart up there, Mark.
S&P. All right.
S&P. Just want your thoughts. So obviously the amount of total return that these Magnificent Seven account for in the S&P is quite substantial. And obviously that's part of the reason why we've seen such a big rally. So can you speak to that at all? What are we seeing? What's the reason behind such a big rally in the Magnificent Seven?
Well, I mean, we're talking about AI, a big part of it, right? I mean, yep. Everybody's talking about artificial intelligence and what that means for the future. Every everywhere you turn, that's just the new technology. That's the biggest thing. It's sort of a new era in technology, and it really is. And it's anybody that's involved in that is it's just super positive. The Nvidias of the world, the Microsofts, everything is like connected to AI somehow. So
Yep.
those numbers look good. I mean, you had Nvidia recently just had blowout earnings.
Two
I
billion
mean,
earnings
I mean, they said
revenue surprise on the
blowout
upside.
earnings, right? So here's the Nvidia stock, and it's been probably the top performer
Yep.
this year. If you look, this is a weekly chart. So this is back in January, this stock was at 148, and today it just closed today at 467, right? So it's one of them. Microsoft's another one that has just exploded this year, especially in recent days since their last earnings report. Microsoft popped up again, going back to January. It's a $239 stock, 240, and today it's 374. So you see these moves. I mean, look, I just showed you the S&P. Look at this move since earnings came out in late in kind of that same time that the whole market, Microsoft has really moved a lot. It's pulling back a little bit, which it needs to in a healthy way. But you just got Apple, all these what they call Mag sevens are connected somehow to the AI, and it's kind of been it's been super popular. So the multiples are high. I mean they're expensive stocks you're buying right now. They're just in the multiples are just I mean it's Microsoft's got a P ratio of 36 right now,
Yeah.
with a growth rate of 27%. So I mean it's got great growth, but the question is how do they continue to go up, or do they maybe stay sideways here for a while? So the Mag 7 is important, and part of the reason the S&P 500 you see it there, which the S&P 500, you think about them being 500 equally weighted stocks, but that's not the case.
Mm-hmm.
Actually, the Apples, the Microsofts, the Nvidias, they actually have a higher percentage of the S&P 500. So that's what you're seeing here. You're seeing, those stocks even, those percentage higher, even though it's not equally weighted. There's a way though. We always look at, you and I talk about the equal weighted S&P. So here's RSP is a good thing to look at. So this is the S&P 500 equal weight. In other words, what the market with all the other 500 the other companies inside of it equally weighted. You can see that we're not near new highs at that. But the good thing is you see this chart as it's moving up, we're really starting to get the broadening effect
Yeah.
of all the S&P 500s coming up, and that's a really positive thing. Another way to look at that, is on the Nasdaq. The Nasdaq is really, when you gave the numbers, is Nasdaq's up, significantly, right?
This
This
year.
year.
Yep.
And here,
Nasdaq. Yep. Is up 36.67 year to date.
okay, so this is showing again, and that's so going back to January, you see this bottom in here, right? That was the Nasdaq after a really rough year. We ended in 2022. Here's the Nasdaq, and you can see that recently we had highs back in July, which right now, if you roll a chart across, here you can see that high. We're right back at those highs in July, and we'll be testing those right now. But again, the Nasdaq is one way. If you go the QQQ, which is another thing on the that heavily on the Nasdaq, you see actually in this case it's actually broken through. This is a higher concentrated of the Mag 7 that you were talking about, right? I mean, that shows that the Mag 7 have really thrown the QQQ into a higher place. But again, if I go to an equal weighted situation where you're actually looking at the Nasdaq from an equal weighted position, the QQEW, you see that again, it's good. The Nasdaq's done well, and we're finally getting some broadening too in the Nasdaq as well. So that's been really positive, where you really see that. Okay, really see that is in the S&P 500, which you mentioned earlier. We really need that S&P 500 or the Russell 2000. Excuse me, the Russell 2000, which is their smaller companies, and that's really the bread and butter of the overall economy. That's really taken a hit this year. And like you mentioned earlier, but good news is we're even starting to get, the Russells trying to break out. Today was a significant day. This first day of September, we're up almost 3% on the
Russell,
or
yeah,
yesterday, up on
2.9.
a pretty good amount today, significantly. So we're starting to break out. It's really nice, and that's a positive. We really need the small caps to be a part of this. And again, reason why that happens is interest rates have come down, and the anticipation is they'll stay down. That helps the smaller companies, which is really,
Easier to
again,
borrow money.
yeah,
Yep.
it's easier. So that's important. Plus the financials, um, you know,
Yeah.
they're starting to really, rally again in here too. So all lower interest rates are good for everybody, and that's good for economies, and that's what's happening here.
Oh, around the cycle we go. But yes,
Yeah,
very, very interesting. Yeah, Russell 2000 up almost 3% today. Good to see. Again, still down for the past trailing 12 months, but obviously a great rally here to end the year. Will it continue? That is to be seen. But coming out of economic slowdowns, small caps tend to be one of the first sectors, or not sectors, but market capitalizations to recover. They kind of lead the way, like you said, because of lower interest rates, easier to do business, kind of more pro-growth policy, which obviously benefits the smaller companies because they're able to grow if they want to. So, what's interesting about the Mag 7 though? So I was doing some research and looking at it. The Mag 7, it basically their returns account for 2/3 of the broad equity market's returns, and over 75% of the Russell 1000 gains. So just think
mm,
about that. So, like you said, AI, tech, cloud services. Again, even we've started to see some semiconductor activity in terms of the Intels, which is decent buy right now, where we're at in terms of valuations. Something that I'm watching personally, but you're starting to get some more broader market participation where semiconductors kind of started to take a little bit of a slumber after the run up we saw in the last year. But yeah, it's just very interesting to see. But with artificial intelligence, this kind of being, Internet 3.0 per se, it could be an interesting ride. Again, not saying that it's going to go straight down or straight up, or I'm not giving a prediction on performance, but it's, with this being seen, can revenues and earnings per share growth still continue to climb at the rates that they are? That is to be seen, because it's been quite incredible. You said Nvidia, 2 billion on the upside in terms of revenue surprise this past quarter, which is astounding. $2 billion.
a lot. That's a big chunk of change. I mean,
It's a
they're
big chunk of
doing some
change.
serious business.
But
So yeah. So I mean, yeah, all said, all good. Here's a chart of the Russell 2000 ETF, just again showing the positive things here. Again, overall breadth is good now in the markets. A lot of this is we're breaking some key resistance levels. Again, in this case, that 200-day moving average, which is this dark line here. That's usually either when you come down, you find support at it, and if it breaks it, it's good. Not good, then it starts to really roll over. But also popping up above it. Traditionally, anytime you pop above it, coming off, going back over here, you can see when it popped above it, you had a nice little run. So anyway, today and again this week we popped above it on the Russell, which I think just reiterates the kind of the broadening of the overall market. So good news is right now we have stocks and bonds both going in the right direction, and
yep.
and even gold. I was looking at the gold market. Was interesting today. Here's gold. This is a Spider Gold shares. This is interesting for those who, I'm not a gold. I don't. Not for the gold bugs and the commercials I see all the time, but
Yeah.
the reality is you can buy gold through an ETF and that tracks the gold price. And in this case, you can see here that today was a significant day. Again, going back to these places over here, if you look here and draw a line across, it actually, you can see we kind of broke out today. I mean, or at least right at that that level of a potential breakout on gold too. So lots of positive things to look at in regards to the markets at the moment. So December should be, tend to see when you get above these moving averages, you tend to stay there. I would love to see a period of time where actually the market goes sideways, even
Yep.
slightly down in here
Take some breath. Yep.
to take some breath, and maybe set us up for, beginning 2024, see what happens there. But again, there's you talk about the economy and things like that. I think funflation, all those things, have been a part of 2023. The question is when we get into 2024 and we get through Christmas and this, is that unemployment number, which is up now, is it really going to start? Like, are people spending money now, doing those fun things again, coming out of COVID for a couple of years ago now, and then 2024 is like, hey, we're going to get our we got to rein it in a little bit and start to, save some money. And, we got school loans, all these things that are out there. So it's going to be interesting to see into 2024 if we truly do get that in those inflationary numbers, or if in 2024 we start to get those, the things that we were expecting in a recession to start happening, that maybe we get a slight recession in here, but we'll see. I don't know. It's anyone's guess at the moment.
Yeah, and I think next week we'll do a 2024 outlook. We'll do it a little bit earlier. Obviously, do our research and our next closing bell. Maybe we'll kind of do a 2024 outlook edition, and kind of talk about what to expect during a presidential election year, which is always fun. It's always volatile, but patient investors usually win the day on those election years, and can pick up some opportunity zones to invest in. So interesting point about gold, though. I mean, you look at gold today, you said broke out. Last thought I wanted to drop in here was, the ceasefire between Israel and Hamas ended today. So kind of interesting, people piling into gold. Obviously, the doomsdayers are people that want, risk off assets kind of piling into gold. So kind of an interesting observation. Is it true? Don't know, but and just an interesting observation with what's going on in the geopolitical world, which gold usually has a large part to play in that. So
here's a weekly chart of the gold. Again, the ETF tracking the gold price. You see this. This is what this is this week. So each one of these each of these lines is a week now. So this shows that this week and mostly today on Friday, that the market really popped up, which is above some levels here. We've been here before, back in August of 2020. This is going back to 2020, so we're getting closer to those highs of 2020 that are interesting. I'm looking at a monthly chart. Yeah, so it's the same going back to 2011. Actually, I mean, you can even see it was higher up here before. Again, this is an ETF, so it's not that tracks gold prices, but interesting. It's interesting to watch, see what that means for us going forward too.
Absolutely. All right. Well, that's it for this week's edition of the Closing Bell. It's good to be here with you. If you have any questions, call, text, email. Again, compliant texting, of course. But we're always here for you. And for Mark and Jason, we'll see you next week.